Assalamu alaikum. Hello everyone. This video and lecture is a sequel to part 1's lecture on regulated investment companies. In part 1, we discussed the basics of an RIC, their functions, one of its major types, the open-end mutual funds, and the net asset value, its concept, and its calculations. So what we'll try to learn in this lecture, there are three things about which I will be talking about mainly: the costs of investing in an RIC, calculating the rate of return for an investor who invests his amount in an RIC with simple calculations and after accounting for different expenses. And we'll briefly talk about the closed-end funds and how they differ with the open-end funds or mutual funds. So, talking about the costs of investing in an RIC, there are mainly these three types of expenses which we can encounter in an RIC. And the first two are mainly related to the open-end mutual funds. We call these transaction costs as loads. So we have a front-end load and we have a back-end load. Now, front-end loads are expenses which are levied or which are charged when an investor invests amount in an RIC. That is why it is known as a front-end load, because they are charged at the beginning. They are also known as sales charge or commissions. The percentage of front-end load and back-end loads, they may vary from fund to fund, but mainly they range between 6 to 8% of the total amount invested. Back-end loads are the loads when an investor withdraws his amount. So that is why the name back refers to the at the end, or when investor redeems his shares or investment. Again, its percentage is not more than 4%, but it reduces as the time passes by. So every year the back-end load decreases as the time passes. And operating expenses, these relate to the administrative and advisory services which the professional manager provides to the investors. So they charge for these kind of services. And there is also one other charge which we call as the 12B1 charge, which refers to one of the rules of the SEC, Securities and Exchange Commission's rule. And it is mainly related with the costs of advertisement and promotion of the investment companies, their brochures, prospectus, and all the printing costs. Now, some of the authors, they categorize operating expenses and these charges separately, but 12B1 charges are actually part of the operating expenses because advertisement and promotional expenses are part of operating expenses. So I have considered these charges as same as the operating expenses. And just like these percentages, operating expenses do have a percentage also. They range between 0 to 2% of the whole value of the assets of the RIC. Now, there are few things which I would like to share with you regarding these expenses and to note them. First is that these loads, the front end load and the back end load, these loads are mainly for open end funds, just like I explained earlier. So they are only for open end funds. Whereas operating expenses and these charges relate to both open as well as closed-end funds. Fine. So this is point number one. Point number two, that operating expenses and 12B1 charges, they are charged annually as part of the procedure of the RICs. Whereas these loads, the front end and back end loads, they are only charged when there is a redemption or there is an investment accordingly. So front end loads are only levied or only charged when an investor invests the money, and back end loads are only charged when an investor withdraws or redeems his shares. But again, there are funds which may charge or may not charge these loads. So we can have a fund which charges front end load but not the back end load, and vice versa. And we can have no load funds also. So depending upon the type of the funds, so these percentages and these loads expenses may change, but the point is same no matter what, that these loads are mainly for open end mutual funds, whereas these operating expenses and these charges are for both open and closed end mutual funds. We'll have some examples which will clarify these expenses. So let's have the first example. Consider an open-end fund that has a net asset value of 10.7 per share. It is sold with a front-end load of 6%. What is the offering price? Now, as discussed earlier, a front-end load is charged whenever an investor is investing his amount in an RIC. So technically, he is paying more than the NAV. So the amount which the investor pays, and that includes the front end load, is known as the offering price. So how to calculate the offering price? We have a formula for offering price, which is equal to offering price is equal to net asset value divided by 1 minus load percentage. So let's put the values and see what we get. So the NAV is 10.70 divided by, we have a front end load of 6%. So we can write 1 minus 0.06 and we get 11.38 as the offering price. Now let's see the logic behind this formula. Why we have divided net asset value over 1 minus load percentage. You see, offering price should be such that after removing the percentage load from this, we should get back the NAV. So let's go in reverse fashion to see the logic behind this formula. Since I'm interested in finding the offering price, so I can call this offering price to be X. So what I'm saying actually is that how much should be this X or offering price, so that when I subtract the front end load, which is 6% of this offering price, so that I should get back my net asset value. Fine, so this X is the offering price, which I don't know yet. And what should be the price, so that when I will be excluding the effect of this 6% load or any percentage, so that it should give me back my NAV. So now rearranging the formula, I can solve it now algebraically. So taking the X common, I will be left with 1 minus 6% is equal to net asset value. And after isolating X, I can get net asset value divided by 1 minus 6%. So you can see we are actually getting the same formula which I wrote earlier. So this is the logic behind finding the offering price. So whenever we subtract the load percentage from the offering price, we should get back our net asset value. So never charge directly the load on the net asset value. What I mean to say is that it will be wrong to say that you can just increase the net asset value by 6%. This method is wrong. And to see why, because it fails this logic. So let me clarify this point also. For a moment, let's assume that we follow this method. So if I directly increase my net asset value by 1.06, this will give me 11.34. Now, if this is the offering price, so after the exclusion of 6%, I should get back the net asset value, 10.7. So based on this logic, let's see if we get our NAV back. So this time I already know my offering price, which is 11.34. So 11.34 minus 6% of offering price 11.34 makes 0.6804. And this gives me a value of 10.659. So you can see I did not get back my net asset value 10.7. Though it is close, but it is still not exact. So that is why it is wrong to follow this method just by increasing the amount of NAV by the load percentage. Let's see the second example. If the offering price of an open-end fund is 12.3 per share and the fund is sold with a front-end load of 5%, what is its net asset value? So this is the other way around. Writing the same formula, offering price is equal to net asset value divided by 1 minus load percentage. So this time we are already given offering price, but we are asked to find the net asset value. So let's cross multiply. So offering price multiplied by 1 minus load percentage equals net asset value. Putting the values 12.3 as our offering price multiplied by, if 5% is the front end load, so 1 minus load percentage should be the remaining percentage, so which is 0.95, and this gives us a value of $11.685. This is the net asset value. It means out of 12.3 which the investor will be investing at the start, 5% will be charged as a front end load or sales commission or sales charge, and the net asset value will be 11.685. So this is all regarding the calculation of offering price. How do we find the offering price if we are given the value of net asset value? And then how can we find the net asset value if we are given the offering price? Let's talk about the second point of our discussion, which is finding the rate of return for an investor who invests his money in an RIC. So just like any other return formula that we know regarding the stocks or any other security, we can find the rate of return in a similar fashion for an investor who is investing in an RIC. So rate of return is equal to net asset value at time 1 or current NAV less net asset value at time 0 or previous one, plus any income and capital gain distributions which the investor might have received from the underlying securities in which the RIC has invested, whole divided by net asset value at time 0. So let's have a simple example on this also. Consider a fund which has an initial NAV of $10 at the start of the month, makes income and capital gains distribution of $0.5 and ends the month with an NAV of $12. What is the rate of return to the investor? Putting the values in our previous formula, we have the rate of return is equal to, so initial NAV, this is our NAV at time 0 or previous one, ends the month with an NAV of 12, so this is our NAV at time 1 or current NAV. So 12 minus 10, which is the initial NAV, plus income and capital gain distribution of 0.5, and whole divided by previous NAV, which is again 10. So this gives us a return of 25%. So this is how you calculate the rate of return for an investor who has invested his amount in an RIC. So this is a simple type of calculation. Let's see another example which is a bit more detailed and complex as compared to the previous one. You purchase 1,000 shares of new fund at a price of 20 per share at the beginning of the year. You paid a front-end load of 4%. The securities in which the fund invests increase in value by 12% during the year. The fund's expense ratio is 1.2%. What is your rate of return on the fund if you sell your shares at the end of the year? Now, this question includes expenses also, the front end load as well as the operating expenses, which is denoted here by the term expense ratio. So how can you solve such kind of questions? Let me write all the relevant data on a new slide. We have units 1000. Our current NAV is $20. So total amount which will be invested by the RIC will be 1000 shares or units multiplied by $20 NAV per share, which is equal to 20,000. So this is the amount which will be invested by the RIC in different securities. However, we have to pay actually more than 20,000 because the question says there is a front end load of 4%. That means first we need to find the offering price per share. So using the same formula that we discussed earlier, the offering price is equal to net asset value divided by 1 minus load percentage. So that gives us the NAV is 20, 1 minus load. If 4% is the front end load, so I can write 1 minus load to be 0.96, and that gives me a value 20.83. This is the offering price per share. Now, if I have purchased 1,000 shares, so in totality, I will be paying 20.83 into 1,000. So my total amount becomes 20,830, considering the offering price. So this is the amount which has been paid by the investor, or this is the amount which is taken away from the investor's pocket. The question says that securities in which the fund invests increase in value by 12%. So the invested amount by the RIC is 20,000. So remember, we do not have to consider 20,830 as the invested part by the RIC. This is the amount which the investor has paid. So after the exclusion of 4% front end load, the RIC is left with 20,000 which need to be invested in different securities. So if 20,000 is increased by 12%, so amount is equal to 20,000 multiplied by 1.12. This means the total amount increases to 22,400. We also have to consider the operating expenses or the expense ratio, which is 1.2% of the invested amount. Now that means we have to calculate the 1.2% of the same 20,000. So operating expenses should be equal to 1.2% of the invested amount. That means if I calculate 1.2% of the invested amount, that gives me $240. So based on the rate of return formula, let's calculate the rate of return for this investor. I'm writing it here. So return is equal to, this is the amount now which is to be considered as the current NAV, because each NAV which was $20 of worth initially is now increased by 12%. So in totality, the total value of the portfolio is 22,400. So 22,400 minus. Now we cannot write 20,000 here because we are finding the return for the investor. So from the investor, this is the amount that was taken away from his pocket. So we should be writing 20,830 instead of 20,000, because rate of return is calculated for the investor, and this is not the amount which was paid by the investor, rather this was the amount which was paid by the investor. And we also have to account for this operating expense. So that means our value should be reduced by all these costs also. So 22,400, the increased value of the portfolio, less 20,830, the amount initially invested by the investor, minus the operating expenses also, whole divided by again 20,830. So just like we did not consider 20,000 in the numerator, likewise we will not be considering the 20,000 in the numerator, because the actual rate of return for the investor should be based on the amount of the money which was taken away from his pocket and not the 20,000. So if we simplify this calculation, we get 6.38% as the return. And of course, if the question also asks for any income and capital gain distribution, so this formula might be or can be extended. But instead of subtracting that amount, we should be adding it in the numerator, because this is something which the investor will be getting. So anything which the investor is paying has to be subtracted in the numerator, and anything which the investor is receiving will be added back. So these are the relevant basic examples for the calculation of rate of return for an investor who is investing in an RIC, which is an open-end fund or mutual funds. Now let's turn our attention to the second type of RICs, which we haven't touched so far, and they are named as the closed-end funds, and how they differentiate themselves from the open-end funds. So one thing which is a distinguishing feature of closed-end fund is that they do not issue additional shares, nor they do redeem shares. That means the number of shares is fixed at the number sold at the issuance. That means once the closed-end funds they issue shares, it doesn't change. The number of shares are fixed. And the investors who want to sell their shares or investors who want to buy shares must do so in the secondary market, just like the stock market, where shares are traded. So they may be trading on an exchange, or they may trade in an over-the-counter market. And the price of the shares of a closed-end fund are determined by supply and demand in the market, just like a stock price. So this is a very common feature which they share with the company's shares. The closed-end funds and different stocks, they share this characteristic. So since the price may change based on supply and demand in the market, so the fund's share price can trade either below or above the NAV. That means the NAV will be calculated only once. Afterwards, the shares are traded in the secondary market, so it is possible that the share may trade below or above the net asset value. Whenever a unit or share is selling above the NAV, we say the closed-end funds share is selling at a premium. Whereas whenever the share is trading below the NAV, we say the share is trading at a discount. So premium and discount are the two words which are famous for the closed-end funds because their shares may trade below or above the NAV, which is not the case with the open-end funds we have seen because their share price always trade at the NAV. Let's have an example for the closed-end funds also. So a closed-end fund starts the year with a net asset value of 12. By year end, the NAV equals 12.1. At the beginning of the year, the fund was selling at a 2% premium to NAV, and by the end of the year, the fund is selling at a 7% discount to NAV. Now, these are the things which you can note in order to recognize a question which is regarding a closed-end funds. For an open-end funds, you will never see the terms premium and discount to NAV. The fund paid year-end distribution of income and capital gains of 1.5. What is the rate of return to an investor in the fund during the year? Now, in this question, we have to calculate the premium and the discount to the NAVs. So let me solve this question. We have current NAV, which we may call it to be NAV 0 is equal to 12. We also have a year-end NAV, which we can call NAV 1, which is equal to 12.1. Now the question says that at the start, the fund was selling at a 2% premium. That means if NAV is 12 and it is being sold at a premium of 2%, so the increased amount can be calculated, or the premium amount can be calculated as 12 multiplied by 1.02, which gives us 12.24. Likewise, at the end of the year, the fund was selling at a 7% discount to NAV. So we can find the discount also. So at the end, the NAV was 12.1. And if 7% was the discount, so I can calculate the discounted value as multiplying 12.1 to be with 0.93. Because 7% is the discounted amount, so the leftover percentage becomes 93%, which gives me a value of 11.25. Now these are the values which we will be using in the return formula and not these actual NAVs, because in closed-end funds we have to encounter or account for the premiums and discounts. So let's calculate the return. So we have NAV 1 less NAV 0 plus income and capital gains distributions whole divided by NAV 0. So we will be considering the premium and discounted values. So if my NAV 1 was 12.1 before discount, so after the discount, the value is now 11.25 minus. If my NAV without premium was 12, so after the premium, the NAV is 12.24 plus we are given the data of income and capital gains of 1.5 and whole divided by again NAV 0, which is 12.24. So this gives us a return of 4.2%. And if the question asks for operating expenses, so we can exclude them in the numerator just like we did in the previous example regarding the open-end mutual funds. So this is how you calculate the returns for a closed-end funds, which is quite similar with the open-end funds examples. The only thing which we might see in these questions is the premium and discount. So this ends the lecture. At the end, I have posted this practice question for you to practice. If you have any question, please post them in the comment section and I'll be happy to answer those. Till then, thank you very much.